The rich pay more taxes than the poor. This is one of the biggest financial myths in America. Warren Buffett, with a fortune of $150 billion, famously admitted he pays a lower tax rate than his secretary. The truth is, the wealthy don't pay taxes the same way regular people do. And the worst part? That's completely legal. Stay with me as we break down the actual numbers, expose how the rich avoid taxes, and show you how the tax system is designed to benefit asset owners rather than wage earners like you. By the end, you'll know exactly how to start playing by the same rules as the rich. Welcome to the Black Sheep channel. They lied to you, and it's time to wake up. The illusion of fair taxes. Imagine two people standing in line to pay their taxes. One is an average worker, earning $60,000 a year, working a 9-to-5 job. The other is a multimillionaire, living in a mansion, flying private, and spending millions like it's pocket change. Who do you think will pay more in taxes? Most people would say, obviously, the millionaire. He earns more, so he should pay more. But that's not how the system works. How the rich pay less taxes as individuals. Here's the fundamental difference. When you work for a living, the government takes its cut before you even see your paycheck, but millionaires play by different rules thanks to their assets. This creates an astonishing reality where America's wealthiest individuals can see their fortunes grow by billions while reporting relatively modest taxable incomes. Take Elon Musk, for example. From 2014 to 2018, his wealth increased by an estimated $13.9 billion, but he reported just $1.52 billion in income. That's because most of his wealth growth came from Tesla stock appreciation, money that isn't counted as income until he decides to sell those shares. Capital gains, the profits from selling investments like stocks or real estate, are only taxed when you actually sell an asset. And even then, they're typically taxed at much lower rates than regular income from a salary. The ultra-wealthy employ what tax experts call the buy, borrow, die strategy. First, they buy appreciating assets like stocks or real estate. Then, instead of selling these assets, which would trigger taxes, they borrow against them. Banks are happy to offer low-interest personal loans with these valuable assets as collateral. The wealthy use this borrowed money, which isn't taxable, to fund their lavish lifestyles. They pay with the bank's own money. Let's put this in perspective. Jeff Bezos, while his Amazon stock made him one of the richest people on Earth, paid an effective federal income tax rate of just 0.98% between 2014 and 2018. Warren Buffett had an effective tax rate of 0.1% at same period when measured against his wealth growth, rather than his reported income. Meanwhile, the average American worker pays around 15% in federal income taxes, plus payroll taxes that take another 7.65%, or double that for self-employed individuals. This creates a system where someone earning $100,000 a year can end up paying a higher effective tax rate than a billionaire. This asset-based wealth strategy provides another crucial advantage: flexibility. Wealthy individuals can hold appreciating assets indefinitely, never triggering capital gains taxes, while borrowing against that growing value to fund their lifestyle expenses. When they need actual cash, they can strategically sell assets in years when they have offsetting losses or deductions. How big corporations pay: almost nothing. If the tax strategies of billionaires seem sophisticated, corporate tax avoidance operates on an entirely different scale. In fact, some of America's largest corporations consistently pay less in federal taxes than the average middle-class worker. We can call them the zero-tax, billion-dollar companies. The corporate tax rate in America officially stands at 21%, but this headline rate bears little resemblance to what major corporations actually pay, which in 2018 not only paid zero federal taxes on $11.2 billion in profits, but actually received a $129 million tax rebate. They weren't alone. Dozens of profitable Fortune 500 companies, including FedEx, Nike, and Netflix, have achieved zero tax years despite reporting billions to their shareholders. How do they pull this off? The playbook starts with aggressive exploitation of tax credits and deductions specifically designed for corporations. Research and development credits, accelerated depreciation, and stock-based compensation deductions allow companies to dramatically reduce their taxable income. Corporations shift intellectual property and profits to subsidiaries in tax havens like Ireland and the Cayman Islands through a practice called transfer pricing. Apple famously relocated its intellectual property to Ireland, allowing it to attribute billions in profits to subsidiaries facing tax rates under 2%. Google used a strategy dubbed the double Irish with a Dutch sandwich to route profits through multiple countries, ultimately paying minimal taxes on overseas earnings. While small businesses typically pay close to the statutory rate, multinationals with sophisticated tax departments effectively operate under a different system altogether. The asset advantage: why ownership beats labor in the tax code. While corporations exploit loopholes through sophisticated strategies, individual Americans face a quieter but equally significant tax disparity. The modern tax code contains a hidden message written between the lines. It's better to own than to work. Let me show you what I mean. The wage income you earn from your job is subject to ordinary income tax rates, which can reach up to 37% at the federal level. But if you make money from selling an asset you've owned for more than a year, those profits qualify for long-term capital gains rates, maxing out at just 20%. Someone earning $100,000 from their job will pay significantly more tax than someone making the same amount by selling stocks or real estate. The message is clear. Our tax code values the passive activity of owning things more than the active contribution of working. The advantages don't stop there. Asset owners enjoy something wage earners never will: tax deferral power. When your assets appreciate in value, you don't pay taxes until you choose to sell. This gives investors control over when they recognize income. Perhaps the most striking advantage comes at the end of life through what's called a stepped-up basis. When someone dies, their heirs receive assets at their current market value rather than the original purchase price. This effectively erases all the capital gains that accumulated during the deceased's lifetime. Imagine someone who purchased stock for $100,000 that grew to $10 million over their lifetime. If they sold before death, they'd owe capital gains tax on $9.9 million. But by holding until death, their heirs receive the assets at the $10 million valuation, completely eliminating tax on that $9.9 million gain. No wage earner could ever access such a generous tax benefit. The system's design reveals clear priorities. While workers see their paychecks immediately reduced by withholding taxes, asset owners can defer, reduce, or completely eliminate their tax obligations through strategic timing and inheritance planning. How you can escape the tax trap. Here's the truth. The system isn't broken. It was designed this way. And if you want to stop being the one funding it, you need to stop playing by the middle-class rules. If the system favors asset owners over wage earners, then perhaps it's time to learn how to position yourself on the favorable side of that equation. The tax code contains numerous advantages that aren't exclusive to the ultra-wealthy. While you might not have billions to shelter, you can still access legitimate strategies that could save you thousands each year. Doing nothing will always be a worse option. So, how do you do that? You start thinking like the rich. Start investing. Long-term investments are taxed lower than salaries. The sooner you start, the better. Start a business. Business owners get access to major tax deductions that employees don't. Use retirement accounts. Tax-deferred accounts like Roth IRAs and 401(k)s allow your money to grow without immediate taxes. Buy assets, not liabilities. Real estate and stocks allow tax benefits and wealth growth. Use debt smartly. Just like the rich, leverage your assets. Instead of selling them, use them as currency for bank loans. The sooner you start shifting your mindset from earning a paycheck to building assets that work for you, the sooner you'll stop being the one funding the system. If you want to know more about this, you should read Rich Dad, Poor Dad by Robert Kiyosaki. This book breaks down exactly how the rich think about money, taxes, and building wealth differently from the middle class. If you want to stop being a slave to the system, you need to read this. Check the link in the description and get your copy. Comment below. Do you think the tax system is fair? Have you ever tried using any tax-saving strategies? If you're ready to stop being financially blind, hit the like button. Subscribe and turn on notifications for this channel. In the Black Sheep channel, you will learn how to develop critical and independent thinking about finance, nutrition, technology, and much more social topics. Remember, they lied to you, and it's time to wake up. Don't miss the next video.